The DHFL scam involving the Wadhawan brothers with an alleged fraud amount of over 34,000 crore rupees. This is a pure corporate bank fraud case involving massive diversion of public money from a consortium of banks. Dewan Housing Finance Limited was once a major player in the housing finance sector. The promoters, brothers Kapil Wadhawan and Dheeraj Wadhawan, ran the company and borrowed huge sums from a consortium of 17 banks, including public sector banks led by Union Bank of India. The loans were sanctioned for legitimate housing finance and real estate projects between 2010 and 2018. Banks trusted the company with detailed project reports and expected repayment from future revenues. But according to the investigations, a very large portion of these funds never reached the intended borrowers or projects. The scam first came to light in January 2019 when an investigative report exposed that the promoters had created a complex web of shell companies to siphon off the money. By February 2019, banks had appointed a special audit. Interest payments started defaulting in mid-2019. RBI superseded the board in November 2019 and the company went into insolvency. CBI and ED launched formal probes in 2020. The Wadhawan brothers were arrested in 2020. Multiple charge sheets were filed by 2022. The probes have continued without break, with fresh asset attachments and court hearings even in 2025 and 2026. Now let us go deep into how this alleged financial loop actually worked. This is a textbook case of loan diversion through shell companies and round-tripping. Banks released massive working capital and project loans. Instead of disbursing the money to genuine home loan borrowers, the funds were routed through a complex web of fictitious entities. These included shell companies and paper firms, many of them linked to a so-called Bandra branch that existed only inside DHFL's internal software system. Fake invoices, over-invoicing and circular transactions were used to move the money back into group companies or personal accounts. The same money was often used to repay old loans from other banks, a practice known as evergreening, which made the books look clean on paper, while the actual debt kept ballooning. Some funds were allegedly diverted for personal luxuries, political donations, and even linked to other high-profile cases. The entire operation involved forgery, criminal breach of trust, and falsification of accounts. The result was that genuine home loan borrowers were left in limbo, while public deposits from ordinary citizens were siphoned off on a massive scale. Let us look at the exact numbers that make this one of the biggest bank fraud cases. The CBI has alleged that the Wadhawan brothers, in conspiracy with others, cheated the consortium of banks to the tune of 34,000 crore rupees to 34,926 crore rupees. That is 34,000 crore rupees, larger than the annual budget of several smaller states. The Enforcement Directorate, which is handling the money laundering angle under PMLA, has attached assets worth hundreds of crores, including flats, receivables, and other properties. 11 out of 40 accused have already turned approver for the CBI, giving the agency strong insider testimony to build the case against the main promoters. At the center are the promoters, Kapil Wadhawan and Dheeraj Wadhawan. The CBI and ED have named them as the masterminds behind the conspiracy. Several other directors, executives, and entities controlled by the group are also accused. The probes are also examining possible collusion or lapses on the banking side. The agencies say this was not a one-off mistake, but a systematic and deliberate diversion of public funds. The investigation is very much active and ongoing. The CBI has filed charge sheets, and the ED continues to attach assets and trace the money trail. The case is being closely watched in special courts, with multiple accused in custody or under scrutiny. Recoveries and asset attachments are still in process, though full resolution for the banks will take time due to the complexity of the transactions. Supreme Court has been actively monitoring bail pleas and issued directions on surrender and medical issues for the accused. This is public money, your deposits in banks that were lent out as housing finance. When such large amounts disappear through diversion, it leads to higher non-performing assets for the banks. Ultimately, this means higher interest rates for ordinary borrowers, weaker banking system, and indirect burden on taxpayers. Thousands of genuine home loan applicants were affected because the money meant for them was never used properly. It also shakes public trust in the entire housing finance sector. The broader lesson from this case is clear. Housing finance companies and NBFCs can sometimes exploit gaps in lending oversight by using complex corporate structures and fake entities, but the system is pushing back hard through parallel CBI and ED probes, asset attachments under PMLA, and stricter monitoring by regulators. This case shows that even large-scale diversion eventually gets exposed when multiple agencies work together. Public money cannot be treated as private capital for personal gain. To sum up, the DHFL scam involving over 34,000 crore rupees is one of the biggest bank loan fraud cases in India, built on systematic diversion through shell companies and evergreening. The probes are still active, with key accused under investigation.
transaction and assets being attached. The final outcome will decide how much the banks and the public can recover, but the message is loud and clear. Accountability in financial institutions is non-negotiable.